Hello everyone, my name is Noshin Zainab and I welcome you all to KiwiTech's 808 workshop for startups and entrepreneurs to help them navigate the challenges of starting a business, making it sustainable and taking it to the next level. Today we have a mentor session on the life cycle of an angel investor's decision to invest in a startup by Dr. Alan Mink, co-founder and deputy director, MIT Alumni Angels of Washington, D.C., and Michelle A. Chlaski, Deputy Director and Selection Committee Chair, MIT Alumni Angels of Washington, D.C. We have recently introduced a referral program at KiwiTech. This program rewards anyone who contributes to fruitful introductions to our company. Over the years, we have built this robust ecosystem of startups with the help of your trust and subsequent referrals. We realize it is time we give due credit to this trust through our referral program incentives. So if you know someone looking for tech development support to scale, join our referral program and follow the mentioned steps shown on your screen, or visit our website www.kiwitech.com to learn more, contribute to our growth journey, and earn incentives for your trust in us. And now I would like to invite Dr. Alan Mink, co-founder and deputy director, MIT Alumni Angels of Washington, D.C., and Michelle A. Chlaski, deputy director and selection committee chair, MIT Alumni Angels of Washington, D.C., to take over the screen. The screen is all yours.
Shane, thank you very much. And we're very honored to be here today, Michelle and I. So we're going to talk to you today about the Angels' perspective for investing in startups. So we'll run you down a path. But first, you see, here's a picture of Michelle and me. Michelle, anything else you want to add about your background for today?
No, I think that sums it up. I'm just really happy to be here, though, and I do want to thank KiwiTech for inviting us.
Yep, same here. So here's our game plan for today. We'll tell you a little bit about our angel background, particularly MIT Alumni Angels at DC, and then an overview of our perspective from an angel. So it's like two-sided, two sides of the table. You have your side as an entrepreneur and a founder and a startup. We'll give you our side as the investor so that you can see our perspective. And we value hearing yours. You'll learn more about that later. And then what most startups and founders don't know is that the decision process for an angel investor isn't just a point in time, but rather it's a life cycle. And we'll talk you through the life cycle that almost all the angels and angel organizations use, whether it's explicit or implicit. So you can see how to work with that. So that's our game plan for today. And we're going to leave a lot of time for Q&A. And we've asked our moderator to keep us on time. So she'll keep us paced. So with that, a little bit about MIT Alumni Angels. So we are the DC, Michelle and I belong to the DC group here. You can see founded about 4 years ago with about 140, 150 members now. And Northern California, Boston Life Sciences, another Boston one, New York, and then it's grown internationally recently. So a large impact globally. And we work together. We network, particularly since COVID and Zoom. We'll send out invitations, and fellow angel investors, over 1,000 now, are exposed to those that pitch at any of our events. But there's another important aspect to bring out that you should be aware about any angel or angel group, okay? And that they differ tremendously in how they assess you, the process for assessing you, not so much the criteria, but the process. Okay. MIT Alumni Angels at DC, we do this collectively. So when you pitch before us, we select you, we organize a pitch event, we have a large audience, like I said, that's global, and then we'll do the due diligence with you in a Q&A with a single point of contact to help you. So it's a one-to-one as opposed to a one-to-many. Some angel groups or friends and family, you're approaching as a one-to-one with many. So you end up being a one-to-many span of control, which consumes a lot of your time. But the investment, we do the investment, actually sign the paperwork individually. So a contract with you as a founder for funds would be with me, with Michelle. It would not be with MIT Alumni Angels of DC, which is an alumni group and a nonprofit, and under the MIT alumni umbrella. So that's who we are. We tend as a group to have many graduates of our MBA program, Sloan, and people with deep technical background. And DC is a bit unique in that we understand dual use. So later when we talk about, does it matter where your angel investors are? Perhaps not in today's day of Zoom, but if you need certain expertise or connections, which Michelle will talk about, then it really does become important, perhaps where they are. So if you had a technologist for the commercial world and the government, for example, DC is a good place to look for investment because the angels there are familiar with that business model. So that's MIT Alumni Angels. I turn it over now to Michelle to kind of give some high-level views of us.
Okay, great. Thanks, Al. Yeah, as Al mentioned, I'm looking at this from a selection committee chair perspective, but also as a general angels perspective. And there's several overarching insights that kind of I look at when I'm looking at a venture. The first is that this is a business relationship. And as in any relationship, there's two sides, the venture and the investor. And as Al mentioned, we're primarily going to be talking from the investor point of view. I think it's important for people to remember that investors essentially are also your customers and your strategic partners. As an angel investor, I'm choosing to invest my personal funds into your team, idea, and business strategy over other opportunities, personal opportunities, and other investment opportunities. And I think that's really important to remember. These are my personal funds. And not only am I investing my money in you, I'm also investing my time, expertise, and connections. Because once I've made that investment, your success is tied to my success. Securing angel investment is not just a one-off business deal. It is the start of a business relationship, and hopefully a long and fruitful one. Leading into that is communication. As we all know, a healthy collaborative relationship requires good communication. As an investor, my assessment begins on an investment opportunity begins at first contact and continues through that whole life cycle, through post-investment and potential additional investment. How you interact and communicate with an investor is representative in many ways of how you will interact and communicate with internal team members and also with external customers and partners. That leads to transparency and honesty. Do not oversell and underdeliver. Misrepresenting your milestones achieved is a breach of trust. And most, if not all, misrepresentations will be uncovered in the diligence process. Trust is foundational, and it's hard to regain trust once it's broken. And my last point is that this is personally how I look at a lot of ventures. It's a venture triad. I look at three main aspects, and these are the things that I'm actually investing in. I'm investing in your team and your leadership team, in you as individuals and as a collective team. I'm investing in your technology and your product, and I'm investing in your commercialization strategy. So I think it's important to keep all of this kind of in mind when we go through the rest of our life cycle. Okay. Next slide, Al.
So now we talked a little bit with those overarching philosophy about the relationship of an angel and you as a venture. Let's talk about the life cycle of investment. And you can think of a rough analogy most of us are familiar with is applying to college. So, are you ready? Do you have a startup ready? Are you ready for funding? Right? And then like college, it's like, are you ready for college? Do you have the right prerequisites? Then you apply, you might be selected. Maybe they're going to have, if you're going to graduate, you'll have some orals you have to do, a presentation, or at least defend a dissertation later. And then there's some follow-up questions and research before the big check mark it says that you're accepted, or for PhD that you graduate. And then even afterwards, the alumni association gets you, right? So there's discussions, and it could lead that you go for another degree. Well, in case of startups, it could be that you need more funding later, and it starts another cycle for your next spurt of growth. So the cycle goes around, or you may know other startups and you recommend them for angel investment. So that's the cycle. And of course, you want to get all the way down to successful post-investment, right? And you don't want to get derailed on any of these, no off-ramps. So we're going to talk something for each of these steps about how it works. In other words, the process, what really goes on for application and selection or a pitch event. with your pitch deck. And then what's being looked for? You know, what are the green flags and red flags? What's going to make you successful and what's going to get you put into the other lane? If it was college, what's going to get you accepted and what's going to put you into the other pile? Okay, so that's our life cycle here. All organizations follow something very similar to this for investment. Even individuals do, individual angels. So with that, let's go ahead and move to the application selection. Michelle, as you heard, leads that. There's a great position to tell you about it.
The MIT Alumni Angels DC application process is web-based, quick, and fairly similar across all the angel groups. We are batched for periodic review, and we try to have 3 to 4 events through the DC group a year. The venture is notified when we receive the submission and as well as when we begin the selection process, and any updates are encouraged and welcomed. As you can see, we have a 2-phase evaluation, and we actually have a selection committee made up of about 6 to 8 active angel investors from our group. And there's 2 phases. The first phase is like a triage. And in this phase, each selection committee member individually and then collectively looks through the submitted materials, which are the venture name, the website, the founder's LinkedIn, a sector, fundraising round, term sheet, company profile, and the pitch deck. And we're looking for 2 types of things. First, from a venture info strategy perspective, we're looking for a clear, concise explanation of what the company does, the product, the problem it solves, the initial target customer profile, and how the venture solution is unique and preferable. But as I touched upon in my initial slide, I'm also looking at kind of administrative and interpersonal skills. Is there missing material from a submission without explanation? As Al said, would you ever submit a college application and not submit the essay? Is the venture withholding key submission requests like the pitch deck? Are the links to the website and the pitch deck not functioning? Are the LinkedIns not current? And is the venture not listed in those LinkedIns? So we're kind of doing a combination of both of these types of skill sets that we're looking at. And we're ranking these companies red, yellow, and green. Red companies are ones that, based on the submission, we're just not interested in. You know, maybe it's just a bad fit for the group. Yellow companies are ones that you're enticing us, we're interested, but there's just a little bit more information we need to find out before we can really make a decision. Green ventures look great, but we still want that touch point. So we move to phase 2. All the yellow and green companies move forward, and each venture is assigned a selection committee lead. And in the deeper dive, we add some external research and a selection committee lead founder one-on-one. And the things we're looking for at this point are a timely response to the selection committee request for a follow-on interview. So we're getting back to that kind of communication. We're also looking to see if our external research is consistent with what the venture submitted. We're looking for a demonstrated fundraising readiness. Are you really ready, as Al said, to apply for college? Do you have all the prereqs? Are you really ready to raise funds? And finally, the one-on-one between the lead and the founder. Is the founder able to address concerns and questions in a thoughtful manner? And extra bonus points if there's already additional slides available to kind of address some of those gaps. As an extended part of your pitch deck that maybe you didn't apply and didn't submit, like appendixes, essentially. Once all of these interviews are completed, the selection committee reconvenes, and collectively we determine our top 5, 4 to present, 1 as an alternative. And I really want to emphasize here that we are not being invited to present at that time does not necessarily mean that we do not see a viable investment opportunity. It's just possible your venture may just not be a good fit for ours at the time. So I think just to reiterate, in this 2-phase selection process, we're looking at this key characteristics of your venture, the leadership team, technology, product, and commercialization strategy. But we're also looking at, do you have the skill set to develop a very fruitful and business relationship with us? And so at this point, we've now invited our 4 ventures to present at our event. And so we then have our actual pitch event, which Al is going to talk about.
Thank you, Michelle. And then the numbers of different angel groups can vary. It's also a trade-off between depth and breadth, right?
Mhm.
So if you're talking to an angel group and they say, we'll have 4 or 5 presenters, that's good because you get serious investors and they'll do serious questions. On the other hand, your chances of being selected might be a lot lower, right? So consider those in trade-offs, how selective the organization is for that. Okay, so Michelle talked about the how and the what of being selected to pitch and applying. So now I'm going to talk about the how and the what for a pitch. And we have an event coming up here in a week, to this day, in fact. So I just copy pasted some of the stuff from our upcoming event. So this is our agenda, opening comments like you saw here from the webinar, your venture pitches. But what you may not realize is the angels get together and huddle afterwards. Okay, and then they wrap up and they'll often record it. So those that couldn't make it can review the recording and the slides. So be prepared that you're going to be asked to allow your recording and your slides to be given to other angels. And you want that because the more people look at it, the more likely to join in, even if they didn't attend the event. Probably, I would say from our group, half the investors missed the pitch event, but watched the recording or slides and still joined in. So let's look at one of these agenda blocks, your presentation. Okay, the amount of time that you get varied, like Kiwi Tech may give you 5 minutes for some events, right? Rapid shoot-offs, some are deeper. Ours run a total of 8 to 10 minutes for your pitch and 5 to 7 minutes in Q&A and let you have that flexibility. So if you do the math, that's 15 minutes per block. Okay. And the presenters, sometimes you're allowed to hang in and listen to other presenters, which is really good. Other times you just hear your own and you got to step down, but we let the presenters stay. So after all the presentations, here's this huddle I told you about, right? And a good block of time for it. So we'll go through and look at each venture, kind of get the key points for it, summarize it, look at the pros and cons, and then see how many investors are interested and who's going to lead the due diligence. So know that that's going to happen at the end and understand that process of how they make the decision. If you don't know, ask that question before you pitch. What are next steps and how are they made? So again, it's like knowing your college application process. So, okay, that's the process of a pitch event. What do we look for as angels? So here are the buckets that we look for, which is, again, I've been to other angel groups too, very similar. So, we say, is there really a market out there, or is it just a nice idea, but really not a good market? Okay. And where do you stand in terms of being competitive to other folks who could supply it? And there's always a status quo. So when we hear there's no competition, that's pretty much a red flag for us. And by the way, as far as marketing goes, if your answer is we're going to get 1% of a broad market and you really haven't thought through it, that's a red flag too. Okay. The team, what do we think about the team? Now, in selection, Michelle told you about the leadership team. But when it comes to the presentation, sure, there's a slide on leadership team again, but it's really who's ever presenting, which should be the founder, not some surrogate. Okay, the key person you're going to be dealing with is the CEO. Okay? And how did they communicate? How honest were they in Q&A? Right? Were there any falsehoods? Because the angels are a sharp group generally. And particularly the MIT group. So, how well did it track? Are they doing something that someone else is doing, and they're saying there's no competition? So again, that honesty that goes with it. They lose that, that'll show up in the observations. And here's something that's key: business plan and strategy. Okay, this isn't just a timeline, but perhaps the most important part of this isn't just financials. Okay, that's just crunching numbers on a spreadsheet. It's sources and uses of funds. What money have you raised and how did you use it? And with the money you're going to get from me as an angel and my other colleagues, right, for this investment round, what are you going to do with it? Okay, more importantly, why will your company be worth more at the end of it? Is it just to pay salaries? Is it to pay off some outstanding debt? Right? Is it just to continue research, but not with the milestone? So really have that phase points. And just like graduating from college, right? You have a degree. So this money is going to get you to this milestone and be compelling why that milestone is so great. And you're going to have such a higher valuation is really key, and showing them how you're going to get there. Okay. So that has an asterisk because that aligns with the commercialization that Michelle gave in her original talk. And finally, there's the technology and risks. Those two tend to go together. There's more risks about the tech usually than the business plan or even the competition. So, and as the founder addressed the risks and articulated them and has a plan for them, the worst thing is to say there aren't or to be ignorant on them. Halfway is to say, we see some of these risks and this is something we're going to continue to work on, at least acknowledge them. Going back to that honesty and transparency. So, and then we have a general bucket. There's lots of other areas. And you'll see this when we talk about due diligence as we dive down. So this is what we look for. And you can see that this is more detailed than selection process was, right? A little bit deeper that comes out of it. Generally here, we'll pick a lead facilitator. You can see the name is here already. And that person will lead follow-on due diligence for the whole team of angels for MIT Alumni Angels. Because again, we're not a fund. Some organizations have an actual fund, and it's the one fund that invests with you. For us, it's collective due diligence and then one investment. So Michelle, anything else to put on for the pitch?
Nope, that's good.
Okay. So we got a lot more I could talk on. We can come back in Q&A if you want on the pitch. And Machine and Natalie, we also can bounce off thoughts of the pitch deck that you all have, that Kiwi Tech has, which in general I thought was very good. So the bottom line though is tailor your pitch deck to the message you want to give, and realize different people will have different style ideas. Like move this slide up, move it back, right? I wouldn't get caught up on that. Make sure you have a comfortable storyline and that all the pieces fit. It's not just a bunch of modules, and you can explain how they all fit. And if you're comfortable with that storyline and it works for you, then that's the storyline to use, as long as you can cover the check marks. All right, so that's the pitch. So you can see that's over here. And then after the pitch, the angels dive into your company, commonly called due diligence. And Michelle, has led and I've led those. She's going to talk you through the process and what we look for due diligence.
Okay, thanks, Al. And I do want to point out one thing that Al's underscoring too. We're at every phase of that life cycle, we're adding more and more information ultimately to come to some kind of decision point. And I think what's important is at each phase too, we open up, we're opening up to more and more of the investors, all of which are MIT alums who have expertise in different technologies, legal expertise, and also business expertise. So we're having more and more eyes looking at something from different points of view, and therefore generating more questions and confirmation of some of the information that you may have presented. So our post-pitch diligence is a process that is very unique to each diligence. I've led many diligences, no two are ever identical, but the administrative process is similar. And this is essentially in the teal color, is pointing out what our mostly administrative steps are in terms of doing a diligence. And it starts actually before the pitch event occurs, because we ahead of time pre-schedule investor follow-up calls the week after the pitch event. And these are venture-led and venture-driven. And so what I first look at in that initial post-event due diligence is the venture coming to the meeting prepared, and are they driving the conversation? A key is that there's a lot of information that the venture can pick up on during the pitch. What was asked in the Q&A? Can you kind of read between the lines? What are some of maybe the stumbling blocks? And that you come prepared to address those, and you have the appropriate slides. It's really important, and I'm going to say this multiple times over this diligence section, is that you listen to investors, that you listen to their concerns and you're prepared to address them. If after the pre-scheduled meeting, they're still interested investors, we then form a diligence group. And that's if you can see that orange row, what we're going to start at that point now is to ask for additional information. Another really important thing is that you are prepared with a data room and a term sheet, because the quicker you can get that information to us, the faster we can move the diligence along. And again, I want to emphasize, and this will be followed with multiple meetings between the interested investor group and the venture, and as well as some investor-only meetings where we'll generate some of our questions and our concerns, which we do share with the ventures prior to the follow-up meetings so that you can come prepared. But what's really want to emphasize is that it's really important that you listen to investors and you address their questions and concerns to the best of your ability. Don't dodge the questions, don't redirect, don't oversell, and be honest if you don't have a good answer. Another key thing we look for is that you bring appropriate team members into the meetings to discuss or address areas of their expertise. We're really looking, is this a team effort or is this a one-man show? We want to see a team effort. We want to see that you know the gaps, you know your own, as a founder, your own personal strengths and weaknesses, but you also know you accept your weaknesses and you surround yourself and pull in team members or advisors that can fill those gaps. And if we can just go to that final slide, Al. Right before this, I do want to point out, and we can discuss this more in the Q&A. As I said, the process, the administrative process is basically the same, but the direction that the diligence takes is very unique to the venture. So I'll just quickly touch on some of the areas investors look at: the breadth and depth of leadership, competitive advantage, intellectual property, and where you are in your phase of that, in your patent phase, the competitive environment, your commercialization strategy, which does involve, as Al said, less about the number crunching and more about what is your plan to grow your business and grow out of your beachhead market into your total addressable market. And finally, again, I just want to point out the key, that the number one key is preparedness and your ability as a founder and a leadership team to adapt to whatever path the diligence leads you down, and being willing to go with that. I think that's really critical. Okay, we can go to that last slide, please. This is, I just want to kind of go back and touch base with what I started off with the overarching insights, because I think this is just sometimes overlooked and yet such an integral part of angel investing, which is, as investors, we are creating business relationships with ventures. And a lot of this process, the submission all the way down to investment, is about building an investor-venture relationship that's fruitful, and that's a good business relationship. And so at the center of that is the communication and trust. And we've both refocused towards that, right? Like, you have to have good communication amongst your investors, amongst your customers, and you have to have a foundation of trust. That's really important. And what feeds, and then that allows the information flow with respect to the details of your venture, your leadership team, your commercialization strategy, technology and product. And then you're really working in a partnership with your angel investors. And I just want to leave you with this thought, which is that every submission, every pitch is an opportunity to build investor relationships. If you weren't chosen to pitch or to present, ask for feedback. We will always give feedback, and stay in touch, maybe reapply. If you pitch and you don't receive investment, you've expanded your network, so you've gained something. Stay in touch with interested investors. Send updates and include non-financial asks like network connections, expertise, advice. Continue to build and leverage those relationships. Every interaction is a potential win that can lead to financial and non-financial support as you grow your venture. If you look at this last slide that Al put up, it's a continuous cycle. So how you're interacting with us all along will open up doors for new opportunities to pitch. Or if I've invested in a venture and it's a good experience and you need more funding, I may then reach out to other investors that are in our network to say, hey, look, here's another opportunity. So really can't underscore enough the need to really view this as a business, ongoing business relationship.
Thank you. And so after the due diligence, we'll just leave this up here. The angels, either as a fund for some angel organizations or individually, depending on how they work, we'll do final negotiation and contracting. And the final negotiation might be something like, for our group, we want a seat on the board if we're putting a lot of money into it. So one of the angels has an inside seat. It could be, if you're familiar with terms like cap and valuation, it might be negotiation. We like what we have, but here's what the price has to be, right? For it, we got all our questions answered. So you get the negotiation and the final paperwork at that point. A lot happens in post-investment. So most founders look at angels as only money, and you'll find that serial entrepreneurs shift their opinion. They don't want a problem investor, but more importantly, they want investors that add more than money. So there's interaction in post-investment. So when you look for money, again, I having been in your seat, I understand the driving need for just money. But I urge you to think about the strings that come with it, both good and bad. Look for red flags and green flags for who you want to invest. The relationship is a little bit like business, marriage, I don't know, whatever metaphor you want. And you want to make sure it's something that you're happy living with. And if you do, that could lead to many participants in the next round. We can give lots of examples in Q&A about where that's happened. Good relationship, right angels to help you, leads to further financing and support, connections for sales, things like that. So, and perhaps you need another round, or of other founders. You say the angel group I worked with, us or anybody else, can lead to new applications and selections, which starts this whole process over again. So any parting thoughts on your side, Michelle, before we close this up?
Just to emphasize again that need to, and you just alluded to this too, Al, to really develop good relationships, because the more you invest in the relationship, the more you'll get out of it. Mm-hmm.
And we realize that, like von Moltke said, no plan survives contact with the enemy, but your business plan will evolve. So again, the communication matters there. Mm-hmm. All right. With that, Machine, we stand ready for your questions.
Thank you, Dr. Allen and Michelle, for the great presentation. So for the audience, they're ready for your questions. Please type them down in Q&A or chat. Till then, we have got some questions in the Q&A. What critical information needs to be in the data room?
Michelle, you want to get that one?
Yeah, sure. So typically the information we would ask for at that point would be things like your financials, your table cap. A lot of times, if there's situations where you've worked with other angel groups and you've already done a diligence with them, they'll include the diligence in that data room as well, so that we can kind of benefit from the, and also leapfrog somewhat and benefit from that diligence. Things like your term sheet, if you actually have like a convertible note or safe or whatever vehicle, that would be in as well. Intellectual property, if you have patent applications, where the process is. I've seen at times, because we've been doing so much stuff virtual, there'll be demonstrations like YouTube videos demonstrating a demo of the product. Really anything you want to put in that you think will benefit the information pool. Al, do you have anything to add to that?
No, just administratively, it makes a lot more sense than trying to email things back and forth.
Right.
You take better control of it as a founder. The version control. So that's all good stuff on your part to have a vault set up.
All right. Are there any angel groups still focusing on idea stage? If so, is it only certain industries?
So at the idea stage, there are some investment groups, but generally for a founder, this is two areas. It's either crowdsourcing there's different types of crowdsourcing, or it's called pre-seed, early stage concept side, and that will be friends, families, and sometimes called fools, because you risk the earlier in the life cycle, the higher risk, right? So those are the sources for those type of funds.
And just to add on to that, I think if one thing that both Al and I talked about was fundraising readiness. So it would be, I think you'd have to have a really good explanation of why you're raising funds if you're just at the idea stage. A lot of the ideas, a lot of the ventures that we deal with are actually, a lot of them started in labs at universities. So they're much more, they already had funding to kind of help through that idea stage. But I know for our group, we wouldn't be interested in something that was just still at the idea stage, because you'd have to really explain to me what you're going to use the funds for.
Mm-hmm. That kind of builds on the other item we said about sources and uses of funds.
Right.
Where you're getting them from, but more importantly, what are you going to use them for? If you don't have a good answer, it's just to pay your salary, you founder, while you continue this entrepreneur life cycle, life stage. That's not very compelling.
And just to build on to what Al said too, with sources and use of funds, one question you will be asked is how much have you individually invested? How much have you and the members of your team invested into the venture? And so if something's still at the idea stage, I think the understanding would kind of be like you're investing your time into that, and that's your upfront investment. So I'd want to wait and see how that fleshes out.
All right. What about if you have a prototype built, but now you're trying to get to the beta?
Okay. So that goes along with the previous question too, right? Machine.
Sorry?
That kind of aligns. You want to cover the previous question too? So that goes around with the maturity of the venture, right? There's a prototype built, but you're trying to get to beta. So in other words, you're really trying to get to a pilot. There's another word. We hear more about pilot as opposed to prototype, but that's kind of what a beta is. So early concept stage, like I have a great idea, or I'm a PhD and I'm working on this technology that could turn into a business. That's the concept stage.
Right.
They are early pre-seed. And so that's definition and the funding. And then you've taken it further. You've gotten validation, not just on the technology, folks, this is important, but on the demand signal. Like you've actually met with some people who might buy it, and you'll understand their pain points, and if they will buy it, and at what price point, right? And some idea of the market. Then that's definitely pre-seed. And seed is the core of Angel, although angels will do pre-seed, is that you have a team to be able to take, okay, not necessarily tomorrow, but you've got someone who can lead, someone who understands finance, someone who understands the tech, someone who understands the market. Okay, you've built, as a football analogy, you've got your team. Even if some are part-time or consultants, you've identified the type of capabilities you need and how you're resourcing them, and you're ready to go. And you've thought through things and have really all the pieces fit together. It's no longer just an idea, but it's an action plan that's integrated. So that's a solid angel. And the angel does risk reduction, right? And it actually gets it to market already. It depends, like bio, for example, has a longer lead time than someone who's just doing a platform and a business model. So that they'll scale faster. But in general, when you're ready to scale, okay, where it requires lots of money to scale, that's when you're going to look for a professional investor. They call it institutional or professional, and that's what venture capitalists are. And then there's private funds, and there's debt on top of it. So that would be a Series A investment, right, for around, they call it the A round. So it's important to know those. And in fact, Ike from your organization is going to actually talk to the angels and give some insights from the founder's point of view on these different types, these different life cycle stages and investment vehicles as well. So we're going to reciprocate with the Kiwi Tech here in a week.
I think to build on to that, if you go back to my venture triad, I'm looking to, most of the angels in our group are looking to invest in companies that have a little part of all three of those, right? That you have a good leadership team, not just one person necessarily, as Al said, you're covering your bases. You have the product, the technology, which is productized now, and the commercialization strategy. So, I think if you're just in that idea stage, it's probably going to be hard pressed to get funding.
Yep. If you have pilot and prototype and trying to get to beta, initial commercialization, that would be appropriate, assuming you have all those other elements worked out too, okay? It's not just one guy or gal sitting in a garage.
Right.
Then that's good to get in angels. And realize the angels look at risk reward. So if you're really risky, someone may place a bet on you, but that's like betting one number in roulette, not betting, red or black, which is safer. 50-50 almost there, right? So they'd expect a much higher return, a lower valuation for your firm at that point. So hopefully did that answer the question about for JC and JS? Hopefully. If not, post again.
All right. Can you share an example of how your angel group made an impact on a portfolio company post-investment to illustrate your point that money is the commodity, so entrepreneurs should look who is behind the capital as the differentiator?
Michelle, you want to do this one?
Yeah, I think a good example, I'm going to use Bounce Imaging, which is it all right if I say
a firm like Bounce Imaging.
A firm like Bounce Imaging, right. This was actually a company that we heard about through one of our Northern California group. So another way of why that relationship is important, they kind of suggested they apply to our group because they need additional funding. But and again, this is a good example of communication too. I invested in them, and they have 4 updates a year quarterly, where they have like a web call with the team and with the investors. And it's not unusual within that call for them to bring up non-financial asks, and those asks be met by investors in the room. Some of it is, this is actually dual use. They have a lot of government contracts. And so there are people in the DC area who have connections. There are a lot of the non-financial asks are actually those kind of connections. Hey, does anyone know somebody in this department or in this industry? We're trying to get a contact to get into this, to move into this direction. And it's really leveraging the networks of the investors. And I think at the end of the day, that actually, it's not unusual for the bulk of those calls to not have any new financial asks. It's all those types of asks. And in that sense, you have those strategic investors, right? It's not just that my success is tied to your success, but I'm bringing something to the table that can help you push your success further along besides money. Often, sometimes money is really not what you need. You actually need the network connections and the expertise and the advice.
All right. Thanks, mentors. We have a lot of questions coming in. So the next one is, do we need to share NDAs before giving access to the data room?
Okay, I'll answer that. If you ask,
so I posted an answer in the
yeah, that's exactly what I was going to say.
It's in
But that would be a deal breaker. People won't sign an NDA.
Asked and answered. Other questions?
So how much is your check size typically?
Michelle, do you want to give your personal one?
Yeah, so I tend to invest at least $25,000 in each venture. And I said we do 3 to 4 a quarter. I'm sorry, a year. And I probably invest in, out of the 4 companies each quarter, anywhere from 2 to 3 of them.
Mm-hmm.
Some with repeat investment later on.
Mm-hmm. So that's about 12 to 20 for our group. And then we network with the other groups. So it's about the same. I think if you look at the due diligence and the time and effort, so for me, it's probably about 10 a year, and average check size is 20. Large for me would be 50. And if I just think it's exciting, but high risk, right? But I want to have a finger on it, it'll be down at around 10K. And then you look at the group, because if you're dealing with individuals, that's one thing, but we're a group. So it's a question to ask for a group, and for a group, it varies among the different regions even, but it can be anywhere from 50,000 to over $1.5 million for our group and the decision of those angels for.
Yeah, I don't think I've ever led a diligence that didn't produce over 6 figures of investment.
I only know of one, and that's just because only 3 people were interested, right?
Right. Well, yeah, that's a small group. So that's just, and that's a very small group, actually.
Yeah. So, but a better question to ask is, what should I put as the minimum investment?
Yeah.
Okay. And I would suggest that answer depends on how much work you have to do. If you're dealing with angels one at a time, not as a group, okay, I would set it fairly high, because it's going to cost you as much time and money to get the deal. But if it's a group, I would stick it. I would suggest 10, maybe 15 on the upside. If you say 25, you're eliminating a lot of funding and potential experts and supporters.
Right.
With that, no, it doesn't cost you that much work. It's not that much extra paperwork. It's not much of extra anything to not, for having lower investors.
And you'd be surprised how many people will join the group and invest 10K, that you actually end up with a lot more at the end of the day. And as Al, I think you alluded to this before, Al, we do just have the one point of contact in the diligence. It's a group diligence that we work together with one point of contact with individual investments. So it's a low overhead to bring your minimum down.
All right. Can only DMV-based startups pitch to you?
No,
And
we're open anywhere. So, so is it the DC area? But here's what I remember, that comment we mentioned earlier, that it's not so much about the geography, it's about the connections and expertise. So that's what I would focus on: connections and expertise more than geography. 10 years ago, the answer would be 5 years ago. I think the answer would have been different for most investors. Now they're very comfortable.
Yeah, and all of our events are hybrid now. And the last few, including the one coming up, we actually have 2 of the presenters are virtual and 2 are in person. And that is representative of geography.
All right. What kind of returns would angels typically expect post-idea but pre-revenue stage? Or is this a case-by-case basis? Should this be shown in the financial plan?
Say the question, what evaluation, or what was it that your question was about?
It is, what kind of returns would angels typically expect?
Returns.
Yeah.
Okay.
Post idea, but revenue stage, or is this a case-by-case basis?
Michelle, you want to cover that?
So if I understand the question correctly, are you suggesting like what kind of returns on my investment if it's pre-revenue or post-revenue?
I'm thinking, think of it in X's is what I'm thinking about it. What X? 2X, 5X, 10X?
Right. I mean, to be honest with you, I think this is one of those examples where you could almost, it would be really hard for you to substantiate the X, whatever is in front of the X, in terms of what my return would be, because we're typically, most of the companies we invest in don't even have revenue yet. Maybe they have, I mean, some do, don't get me wrong. And that way, and that is reflected in the valuation and the terms, but most don't. And so it's more, I think it's hard to put a number on it for me. I'm at that point, I'm looking less about the number, if that's what you mean. I mean, I'm looking at valuation in that sense, but I don't think it would be easy to really put a number on that. And
nope, for me, it would be 5 to 10X, right? And the X is affected by valuation, right? If you have a super high valuation, we're not going to get much of return. We're investing in a $20 million firm with our 10,000. Think about how big that firm's got to be for a 5 or 10X, right? Not likely. So that's why valuation on a term sheet goes with investor interest much.
And I think valuation, and I'm just saying this as a selection committee chair and the things that we look at, if you don't have a qualifiable valuation, one that you can actually defend and explain, and especially if your valuation is over 10 million, odds are you won't get to phase 2 in our selection criteria, because for all the reasons Al just mentioned. So I think the things that we're looking at more, a number we'd look at more would be your valuation, and you will be asked to explain how you came up with that valuation. And it's important that you have a justifiable answer, and it can't just be based on the funds you raised in the past, because there are down rounds, right? And that's another reason why it's important to have a realistic valuation, because you don't want to have to explain a down round.
Does a low yearly revenue for a startup automatically lessen your chances of landing an investor? Is that often a deal breaker, or would you say the person pitch attainable goals matter more?
As I mentioned just before, a lot of the companies we invest in don't have revenue. So I mean, there are some that do, but a lot don't. So if you don't have revenue, I want to see that you have pilot studies, right? Or pilot partnerships, or what's your, for me, it's so critical to really understand what your commercialization plan is. I don't want to just see a chart that kind of goes up like this, you know, with over the years and how much, you know, this is the x-axis is years and the y-axis is your revenue. I want to see your plan, like how are you going to achieve that curve? And that's less important to me than that you have revenue. You could have good revenue right now, but you have no growth plan, and so you're going to be stagnant.
Yeah, you'll be a life cycle company. So, and can you get to it? So who specifically is your customer? What type of firms? What position, right? What are their pain points? What price will they pay? And then you do a build-up, right? Here's what we can price it at. Then here's their cost for production. Here's where we're going to be ready at that point to deliver. And ready is commercialization, like sales team, not just the technology, right? Service desk, everything else that goes with it. If it's plausible, then we have credibility in the timeline. The danger of no revenue is maybe no revenue indefinitely, right?
Right.
And then there's another investment round coming up, and it all goes to pay ongoing salaries for a life stage company.
All right. We have an awesome team, but we are only weak on our sales team. Do you know where a startup might look for salespeople to help us grow the business that would work on commission only?
I think this goes
I
back.
have some ideas.
Go ahead. Do you want to say?
No, go ahead, Michelle.
I was just going to say, this again goes back to, like, sometimes the best investment isn't money, it's your contacts, right? So Al, if you have actual suggestions of partnerships, go ahead.
Yeah, each sales is not sales. This is, if you don't have someone on your team that understands your marketplace, then our confidence is low. You need someone who can run a sales process and understands that. I get that. That's a generic thing. But then you also need someone who understands the marketplace. It's already on the team. If you don't understand the marketplace, then you don't know the pain points. You don't know who to reach out to, right? That, because you can actually subcontract. There's actually several groups depending on what type of sales it is, right? The phone sales, contact, relationship. There's different ways of incentivizing those organizations. You can outsource a lot of that type of work, but you can't outsource the domain insight. And I do not recommend hiring a consultant for domain insight. That I think is going to be someone who's tied to the team, has an equity position, is going to put their name on the company, even if they're not full-time. That's my thought about sales.
All right. Time left for only 2 quick questions. So, how important is the location of the company? Do you invest across the country?
Go ahead, Michelle.
We have. One area we haven't really ventured into is investing in international companies. But yes, we invest that are LLC in other countries. But yes, we've invested in companies from Massachusetts to San Francisco.
I think it's safe to say that it's much more about the business idea of the company for us than the location. Okay, we're less interested in a kind of just a plain business concept or yet another platform with buyers on one side and sellers on the other. Because we have the expertise in all sorts of technologies, we're much more interested in people who have something new
Right.
on the market, as opposed to just, being able to sell pets better or something
Right.
like that, pet supplies.
All right. So here comes the last question. Do you prefer safes and convertible notes?
I'll start with that and let you finish up, Michelle. How's that?
Okay.
So we see three different investment vehicles. Okay, and I'll hit them real quick. Safe, convertible note, okay, and pure equity. So safe is an agreement, basically says you put this much money in, but we don't know what the company will really be worth when. We'll convert you to stock when we get our next round of investment, or a big round by somebody who has all these professionals that will come in and do a professional valuation, the third party that we all trust, right? Because they're big money. But we guarantee that to limit the value, if to a certain amount. For example, if this next round of funding says your company is worth 30 million, we agree to cap it at 10 million, so you're not so diluted, right? $10,000 for 10 versus 10 for 30. But the valuation may come in lower than that too. So it defers the discussion of a valuation. So that's a safe. A note is much like a safe, except it's debt. So it's a priority should the company go under. Debtors are more likely to pay than equity owners, right? And you get some interest, and that interest isn't paid out in money, but rather more your pot of money grows. Let's say it's from 10,000 at 7%. After a while it could be worth 11,000. So at least you're getting something for your time. Okay, and these agreements also might have something like we give it to you at a discount. So you get an extra 20% over what you put in if it takes more than a year for this next round of money. So there's all clauses that go with it. But the difference between safe and convertible notes are very, very similar. And a key factor there is they defer formal valuation. There's it's hard to figure a valuation out. Equity is, we know our company is worth X and you're going to buy a certain percentage of it, an equity note. So sometimes angels will go for that, but the discussion over what you're really worth versus a cap on what you're worth is a different level of discussion. So we would recommend a safe or a note. Personally, I prefer a note for the reasons that you can pick up. It's debt and it's earning interest, right? So the longer it takes a company to grow, at least I'm getting something out of it. Those are my thoughts on those three. Michelle, how about you?
Well, I've actually invested in all three through our group. But I would say, generally speaking, the majority of investors, including myself, prefer the convertible note. And even
I'm sorry, finish up.
No, and even if you use a safe, people will still ask you your valuation and will still want to know your justification for it, because that says something, about your venture and about your team.
As a cap.
Yeah,
right?
yeah. Right.
It's just a cap evaluation.
Right, exactly.
At the future time, when, so it's not today's valuation, it's a cap when the liquidity event happens. The last thing about debt, I'll confess, some of my investments have been big hits, and I've had a couple that have gone under. When I had a note and it went under, for me, it was a loss, a business loss. Okay. If it was a safe, it would have been a different type. It would have been a capital gains loss, right? Long-term capital gains loss, taxed differently. So it's a better tax implication. And most investors, by definition, right, have to be accredited investors, high net worth individuals. So, a difference of 20% in taxes for the losers, matters a little bit. Nobody does things for tax purposes, but it's another reason I like notes over safe. And it could be a tipping point for me whether to invest or not, a note versus a safe.
Yeah, I agree with you. That's very true in some of the conversations, actually. That's been a sticking point.
Right. All right, mentors. Loved the engagement today. However, it is time for us to wrap up. All the unanswered questions will be shared with mentors, and the responses will be shared back with you over an email. And with that, I would like to thank our mentors and guests for joining us today, and we'll be back soon with our more workshops. Also, apart from the workshops, we have more upcoming events. As you can see on your screen. You can check out QE Tech website for the same. Do join us, and we would love to host you on those events as well. Thank you and have a great day ahead.
Thank you.